the bullion banks have been trying to borrow the shares so that they can get access to the physical silver. And they probably need that physical silver because they have clients saying we want the physical and they don't have it. But the lease rate was at 2.5% last Friday. I've seen now that it's above 10%, and there's just no shares in the SOV to be borrowed. So the bullion banks don't have any access to physical, and I think that's one of the reasons why we're seeing, silver up $1.50 today as we speak at 49.40 and fast approaching 50. That's one of the ways to solve a supply or shortage is to drive the price higher to attract people to sell it to you so you can fulfill that demand. The other way, of course, is to produce more silver, but that takes time. So, or maybe the JP Morgan and the other bullion banks can conjure up some physical silver from somewhere, but it looks like they're having a very difficult time. There's something wrong in this system, I think, and we haven't found out yet because every time, it's not like very often we see these kinds of moves. Last time it was 2011, really, when gold topped at above 1900 and silver also topped at 50. We saw the European sovereign debt crisis, and even in 08 when gold topped at 1030 in March. That was the same day that Bear Stearns had to be bailed out. And then you go back further to 1980 when silver topped around 50 and gold just below 900. The economy was in the doldrums. There was a recession. Jimmy Carter was in power. The American hostages were in Iran. Paul Volcker had to eventually let interest rates go up to 20%. Inflation, stagflation was still around. So yeah, there's something, in my opinion, that's gonna pop out of a box. Don't know if it's economic, financial, or geopolitical. I think that's what gold and silver are telling us.
The first major pressure point lies in geopolitics. Several regions could ignite wider conflicts, escalating tensions between Taiwan and China, ongoing instability between Ukraine and Russia, and volatile Middle Eastern flashpoints involving Iran and Israel. Meanwhile, strategic partnerships like Russia's growing military cooperation with Venezuela signal emerging alliances challenging U.S. dominance. The risk of conflict is no longer theoretical. It's embedded in military posturing and diplomatic breakdowns. Historically, wars have driven capital towards safe havens like gold and silver. Investors aren't waiting for headlines, they're reading the signs, and the rush into precious metals reflects mounting unease.
An easy one, I guess, if people have been following geopolitics, is war, right? And there's many places in the world where war could flare up, major war. First one I would say is Venezuela. The Trump administration has been acting down there near Venezuela. And I saw that Russia signed a cooperation agreement with Venezuela earlier this year. So that's one way it could start. We have the Iranian-Israeli situation. We have Ukraine, Russia, and we have Taiwan and China. As for economic let's say event, I would say that the fact that gold is going up and there's a lot of demand for physical gold, not just from central banks now, and also physical silver, could be pointing to some kind of credit problem in the market that we don't know about. And I think ever since 08, the banks have been put under so much regulatory oversight, excuse me, that a new kind of market is developed, like private equity, private credit, which is very opaque, and we don't know what's going on there. We've seen a couple of big companies collapse out of the blue, Tricolor and also First Brands, and that's part of this big shadow banking world. And what else? Inflation. Yeah, inflation. If you look at the money supply in the U.S., M2, that's making new all-time highs, and that's what I see as inflation. But definitely you could see prices rising, especially of basic necessities. And just like the BLS has been fudging and doctoring jobs data, they revise it massively every year. They could be fudging CPI very easily, like they do here in the UK. So yeah, gold could be forecasting many things, and price rises included.
Beyond geopolitics, opaque financial structures are raising alarms. Since the 2008 crisis, regulatory oversight pushed riskier lending into private credit markets. Vast, largely unregulated, and poorly understood. This shadow banking system now rivals traditional finance in size. Recent collapses of major private lenders have revealed cracks few anticipated. Central banks and investors are accumulating physical gold, not just as a hedge, but as protection against credit events that may still be hidden. Rising gold demand may be the market's way of signaling that something is brewing beneath the surface, something not yet visible in official data.
You have to differentiate between people who trade, let's say, paper gold and silver, to people who stack physical gold and silver. I think stacking gold and silver is for insurance, and people have insurance for fire at their house or insurance for driving their car. It doesn't mean to say that if you never had your house burned down that you're going to get rid of your insurance, and you certainly can't get rid of your car insurance. So I think it's the same thing with gold and silver. Of course, if people want to reinvest in another asset or have an emergency, yeah, now is a great time to take some profit and do so. But I would say the place to take profit in the precious metals, if I had to, would be in the miners, precious metals, gold and silver miners, even though I think there's still a lot of room in that sector too. And as for the analogy of Weimar Germany, Zimbabwe, or Venezuela, yeah, I think we need to keep that in mind. It's never happened. Well, it happened in the U.S. During the Revolutionary War. It was called the Continental. It became worthless. They used to call it shin plaster. So Americans and the British as well, they haven't been used to currency collapse. But I think the chances of that happening are pretty high. So that's why I think it's actually a risk getting out of your gold and going back into the fiat dollar or the fiat pound or the fiat euro. If anything, I'd be trying to, even though it's getting harder because it's taking more and more fiat currency to buy an ounce of gold. Yeah, I'd be trying to continue to stack and not really worry about the price.
The surge in U.S. money supply hitting record highs in 2025 has reignited inflationary pressures. While official consumer price indexes suggest moderation, skeptics argue key figures are being massaged, just as labor data often is. Essentials like food and housing continue climbing faster than reported. Historically, nations like Weimar Germany, Zimbabwe, and Venezuela saw currencies collapse under similar dynamics. While the U.S. hasn't faced such a crisis since the continental currency during the Revolutionary War, today's relentless fiat devaluation is raising questions. For many, holding gold and silver isn't speculation, it's insurance against systemic monetary erosion.
got up early for some reason, and then I looked at my phone and I saw that gold was testing 4,000, and it broke through 4,000 around 10 p.m. New York time, which was 3 a.m. here. I was up, and it went to 4,001 and came back down for a few minutes to 3,095, and then it just blew right through 4,000. And I think with silver is going to be the same thing. It could be today or tomorrow. We'll test 50, maybe go to 50.25, and then come back down, and then just go crazy. And there's nothing above 50 in silver, so it's difficult to say where it could go. It could be very easily be at 60 by next week, even though that sounds quite outlandish. I know it's been a long wait, especially since 2021, when it looked like silver was going to break through 30, and we've had to wait until recently for it to go back above 30, and now we're almost at 50. So I think it's speeding, and I mean, eventually, the way to look at silver is to look at it through the gold-silver ratio, which is probably still around 80 right now, I think. Back in 2011, that ratio got down to 30. So I think we'll go to retest that level at least. So all you need to do is see where gold is and work where silver should be in terms of the gold-silver ratio, and then you can work out a price. But yeah, it's just there's so much pent-up energy there in the silver market that's been kept in this 45-year old teacup and handle formation, because these formations are really explosive once you break through not just the handle, but also the top of the cup, which is what we're doing right now.
In early 2025, gold shattered the $4,000 mark during overnight trading, while silver is testing 50, the same level that triggered explosive rallies decades ago. The gold-silver ratio remains near 80, far from the 30 seen in 2011, suggesting silver could have significant room to run if the ratio normalizes. Technical analysts point to a massive 45-year cup and handle formation in silver, patterns known for dramatic breakouts once resistance levels are breached. With supply at London's bullion markets tightening and lease rates surging above 10%, physical shortages are becoming a real factor in driving prices higher.
I've been reading, I don't follow these things too closely. I keep an eye on the price action, but I've been reading that there's been a lot of the supply, the available supply, for example, in the LBMA for delivery is becoming very limited. SLV, the ETF for silver, the bullion banks have been trying to borrow the shares so that they can get access to the physical silver. And they probably need that physical silver because they have clients saying we want the physical and they don't have it. But the lease rate was at 2.5% last Friday. I've seen now that it's above 10%, and there's just no shares in the SLV to be borrowed. So the bullion banks don't have any access to physical, and I think that's one of the reasons why we're seeing, silver up $1.50 today as we speak at 49.40 and fast approaching 50. That's one of the ways to solve a supply or shortage is to drive the price higher to attract people to sell it to you so you can fulfill that demand. The other way, of course, is to produce more silver, but that takes time. So, or maybe the JP Morgan and the other bullion banks can conjure up some physical silver from somewhere, but it looks like they're having a very difficult time.
Perhaps the most profound change is psychological. Investors, institutions, and even central banks, particularly from BRICS and non-G7 nations, are demanding physical metal, not paper claims. They're bypassing ETFs and futures to secure tangible reserves, reflecting waning faith in traditional financial intermediaries. This represents a structural shift. Gold and silver are no longer mere hedges, they're becoming parallel monetary anchors in a fractured global system. Whether the catalyst is geopolitical, economic, or monetary, the surge in precious metals is less about price and more about trust. And when trust falters, history shows gold often speaks loudest.
I think with all the possible situations we spoke about, like economic, geopolitical, inflation, there's a lot of investors out there who are losing faith and confidence in the system, and they don't just want paper anymore. They don't want ETFs. They don't want unallocated gold or silver from their bullion banks. They want the real thing. They're concerned about credit, counterparty risk. So yeah, this is like a new game in town, and also the foreign part of the equation, the BRICS countries and other non-NATO or non-G7 countries, they've been acquiring through their central banks physical gold. They don't buy futures or ETFs. So that's really changed the game, I think, because up until 3-4 years ago, paper was king, and I think paper is not king anymore.